welcome. You're listening to Mortgage Investing 101. This is the show where we discuss high-yield real estate mortgage-backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co-host, Mark Hahn, president of Pacific Private Money, one of the fastest-growing private mortgage investment firms in Northern California. Our goal is to provide information and to increase your awareness of these important alternative investment strategies where you can earn secured high yields, earning high yields using your savings or IRA accounts. Annual yields of 8% or more are not uncommon using these strategies we're going to discuss in today's show. If you like what you hear today, please call Pacific Private Money at 415-883-2150 for more information or go to pacificprivatemoney.com. You can also call our hotline, 888-529-1134, and leave your name and your question, and we'll get back to you after the show. Also, for fun, we're going to have trivia contests before each commercial break where the first three callers with the correct answer will win a free 3-day, 2-night vacation. And the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. And the vacations are free. Lighthouse is only requesting a $75 house cleaning fee. Check them out at lighthouseforfun.com. Today's trivia theme is movie quotes. Okay, Mark, I want you to just get right into it because you are the expert on mortgage investing.
Good morning, Edward. Glad to be here. And we're talking about mortgage investing today. And mortgage investing, you heard right, is a way that you can earn 8% or more using your savings or self-directed IRA accounts. We'll talk about maybe self-directed IRAs a little bit later in the show and how you can take advantage of tax-free growth on your IRA balances by investing in mortgage secured products, which pay just fabulous yields, 8% or more.
And it doesn't have to be just IRAs. You can take regular money.
Any money. But especially for IRAs, some of the mortgage secured products that we're going to talk about today are really made, almost tailor-made for the self-directed IRA investment.
Well, sure. If I can earn 8% with you, in fact, that's what I've done personally. Is I put some of my IRA money.
You're doing personally.
And I'm doing personally, yeah, because if I am earning 8% interest from you, and since you're paying it out, I'd rather not pay taxes on it right now. I'd like to have it accrue.
Absolutely.
Tax deferred.
And mortgage-backed investments are a great way to grow your IRA savings. And so, anyway, for those of you listening out there, if you're a fan of weekend AM radio, and I know that I am, I love when I'm driving around and just kind of go through the channels and see what's out there and who's talking. And most of the shows out there, there's lots of shows about stocks, of course, stock picking and how to make money in the stock market. There's those shows about gold and how you can profit from those who believe that maybe we're going to hell in a handbasket and you ought to buy a lot of gold to hedge that belief. Then there's guys out there selling, I don't know what they're selling. They're talking about making big yields, but they never tell you what it is, and usually that's because it's insurance. They're selling you some kind of insurance-based product, which is usually heavily loaded up front, and I don't know about you, I'm not a big fan of those, but some people like those. And we're going to talk about something that's very rarely talked about, and I think we're the only Bay Area radio show that discusses these investment products. It's an alternative investment, and what alternative investments are basically those that you can't buy from your stockbroker or from your financial planner, because financial planners and such are usually selling you a basket or advising you to invest in a basket of stocks, bonds, mutual funds, CDs, those things that you could buy and are readily
have commissions
associated to it. That too, but those are the things you can buy readily over the counter, so to speak, and they're highly liquid, so you can cash out of them. But the problem is that the returns on those, stocks are of course an equity place. You really don't know what the stocks are going to do unless you happen to have a magic crystal ball, and we already know what bonds and CDs and money market rates and things of that nature are paying. They're just not paying much right now. So the challenge for those of us who are investing for retirement is, okay, I've been kind of slogging through the last decade trying to figure out how to grow more reliably my retirement savings.
Yeah, especially since a lot of people don't realize that when you lose money and we'll just say in the stock market, because that
For example.
For
Sure.
example, yeah. We've said this before, that if you had $100,000 and you had a 25% drop down to 75,000, now you got to make 33% on your money, 25,000 back, just to get to 100,000 break even.
Well, that was the problem with both stock market major drops that we had. Those of us who are old enough to remember what happened with internet stocks. I mean, and even more recently in 2008 when the mortgage meltdown. If you lost half of the value, it has to double.
Yeah, you have to make 100% of your money.
So those of us who have not fared well in the stock market, and I include myself in that category. On the other hand, through mortgage secured investing, we've done quite well, in fact. And I've got clients that have been with me since we opened our doors in 2008 and started doing mortgage secured note investments that have just thrived and have been getting 8, 9, 10% returns on their money.
And they've not lost principal.
And they've not lost principal.
So for the last 5 years, if they've earned at least 8%, that's 40% that they've made.
So a savvy listener is going, well, what about before then? What happened to people who were in these types of mortgage-backed investments before the crash? Or, what happened to them? Well, it depends on what kind of mortgage investment you were in. Now, we are in a new era of lending today, much more conservative than 10 years ago. We are also in a different real estate market today, and one that I believe is probably not staring down the barrel of what we were in 2005 and 6, where we had literally 4 or 5 years in a row of 20% appreciation. We were clearly in a bubble back then. So people who were investing in private notes, if they were first position notes, they were probably okay. But
Sure.
The industry in the early 2000s for mortgage investing were mostly seconds.
And a lot of them were small seconds behind big firsts.
Yes, they were.
That's a major.
And the reason for that is banks were basically lending to everybody. 2002, 3, 4, 5. Anybody could get a bank loan on anything. Liar loans were prevalent. I personally know people who were buying real estate, with liar loans, just making up numbers because they had a good FICO, and the banks and the mortgage brokers were happy to lend them money to buy up all kinds of real estate. Then when the market turned, of course, that all came crashing down. And so as a result, those of us in the private lending business, in the hard money lending business, we weren't seeing a lot of first position loan applications. We were instead seeing loan applications from people who were in distress and needed second. So the point of that is today's market in 2013, and it's been this way now for 5 years. It's a whole new lending market.
Because the banks are tightened.
Because the banks have tightened up on lending, and they're not making loans to certain borrowing segments of the public that are actually very strong, like real estate investors. Okay. So if you're a real estate investor and you're buying, fixing, and flipping real estate, and I know hundreds of people who are, try borrowing money from a bank to leverage that purchase. You're not going to find a bank that will make you that loan. It's just not available today. It may be available again in a few years. I don't know. I don't know if banks are going to even come close to lending like they used to lend nearly 10 years ago. But for the moment, they're not. And for the foreseeable future, they're not. So that provides an opportunity for the private lending industry, which has really blossomed. It's a whole new industry in the last 5 years. We are making smart loans, conservative loans, to people with a clear exit strategy. They're short-term loans, and those loans are in high demand.
Okay, give us an example, because you say that they're conservative loans.
Conservative meaning that we don't generally loan to someone higher than 70% of the purchase price. So if they're buying a home for $200,000 in the Bay Area with the idea that they're going to improve it and then put it on the market and hopefully sell it for a profit, we're going to make them a loan no more than $140,000 on a $200,000 acquisition. So they're coming in with $60,000 of their own cash. Then they're going to improve the property on their own dime, and then by the time they put it back on the market, our exposure, our risk is actually going to be less than 70% at that point.
Sure.
The market value will have presumably gone up with the improvements made to the property.
If for some strange reason an appraisal comes in less than the $200,000, are you doing 70% of the fair market? Are you doing lower of?
Generally, yes. Now that doesn't happen.
It doesn't happen often because people are generally not going to pay more than market
Actually,
value.
with my clients, the appraisal tends to come in higher than they're buying it for because we're making loans to people who are finding opportunities to buy property via short sale. So they're actually getting a really good deal. This is not on the MLS. They're not out there bidding with a bunch of people who want to move into the property and undergoing a bidding war. These are people who have channels of opportunity to buy properties where the homeowner's upside down and they're able to negotiate a very, very stellar deal with the bank to let the property go actually below market price. A lot of people in today's market might shake their head and go, I don't think that you can find properties like that anymore. Well, you can, and repeat borrowers of Pacific Private Money are doing that every day. They're finding deals where it's worth $250,000, but their contracts for $225,000 or even better. So again, we're talking about mortgage investing, which is where you are the lender, where your funds are used to fund a loan to a real estate investor. And there's two ways that we at Pacific Private Money offer opportunities to our lender clients to participate in this 8% or more mortgage investing opportunity. One is through directly funding a loan, a specific loan that's also called trust deed investing. Some people refer to that as, or whole note investing. The other one is the mortgage pool fund, which we have available at Pacific Private Money. And that is a more passive way for someone who may have tried trust deed investing, but oftentimes they get paid back quickly and they go back into cash. And it's a more passive one where our management team at Pacific gets the opportunity to have the fund the best looking loans that we see in the
Okay,
pipeline.
When we come back from commercial break, we'll get into that a little bit more as to why the need for the fund. And you're listening to Mortgage Investing 101. Your host, Edward Brown, along with Mark Hahn, president of Pacific Private Money. And the phone number for Pacific Private Money is 415-883-2150. Give them a call if you have any questions about deeds of trust or mortgage investing. Again, we're not talking about super risky stuff here. We're talking about only 8%, fairly plain vanilla, but that's a great way to return in today's market.
Yep.
Okay, here is our first commercial break. Again, the theme is movie quotes. In what movie does Leslie Nielsen say, "Looks like I picked the wrong week to quit sniffing glue"? You remember that movie?
I do.
The first three callers with the correct, why you have a smile on your face. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. In what movie does Leslie Nielsen say, "Looks like I picked the wrong week to quit sniffing glue"? 888-529-1134. Make sure to include your name, your email address, speak slowly, spell out your email one letter at a time. And also, if you have any questions on mortgage investing, you can also leave a question there too, and we'll answer it. 888-529-1134. Don't touch that dial because Mortgage Investing 101 is going to be coming right back.
Got a little tongue tied toward the end.
Yeah, just a little bit.
Not horribly, I know. It always sounds worse in your brain when you're doing it.
Because you're so excited about what you're going to say.
So going back in again, just for the benefit of the new, people that are kind of jumping channels.
Yep.
I thought I may just say, if I might just read you a short paragraph from a white paper written about mortgage investing. I don't think these guys would mind. They're probably not listening. And if they do, I don't care because they borrowed stuff from me.
Yeah, they probably did.
No, I know they did. I've seen some of their stuff, and it's like, wait a minute, this is the stuff I've been talking about at the meetings.
So you can say, and according to Mark Hahn,
Yeah, right.
Yeah, so I responded to Blackburn and Brown just because I was kind of curious about this thing. They have this 8% deal in Roseville, finally one in California. It's a great deal. $125,000 on a $305,000 purchase, and it looks like a really nice neighborhood.
Yeah.
So I sent in the email basically. Yes, I'm interested, and I prefer to take the whole thing, right? They emailed me back like an hour later. That sorry, it's all gone. You know. So I was thinking about kind of using them, obviously not them as their name, but just your examples of how the deal comes in. That's one of the reasons for the fund. You blast it out.
Yeah.
It's so good. Okay. So when we come back, what do you want to lead in with?
Oh,
I'll say for people who just joined us.
yeah, for people who just joined us, Mark, what is mortgage investing?
Right. Here we go. Ready? Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with my co-host, Mark Hahn, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. He is the expert. When we cut to the first commercial break, we asked this trivia question. In what movie does Leslie Nielsen say, "Looks like I picked the wrong week to quit sniffing glue"?
That's the classic Airplane.
Airplane, that is correct. Okay, Mark, in case people just joined us, can you explain a little bit about the mortgage investing?
So, right, you're listening to Mortgage Investing 101, and I'm just going to read you a short paragraph from a white paper on mortgage investing that I think sums it up pretty well. And that is, many private investors and financial advisors stick with traditional Wall Street type investments, such as stocks, bonds, and mutual funds, and bank products like savings accounts and CDs, or insurance company investment products such as whole life or annuities.
Annuities,
yeah, that's easy to say. So, some of these products do, in fact, make good sense for a well-diversified portfolio, but most people don't realize that there are other alternative investment strategies available to them out there, and these alternative investment strategies, you're really not going to hear about them from your financial planner. And the reason is because these are non-commissionable and they're generally not as liquid as other investments, which again, if you're in it for, as many of us are, you're looking for, midterm investment products, midterm meaning, 2 years, 3 years, 4 years, 5 years, midterm investment products to provide higher yields, you really should be looking at some of these alternative investment products.
So this is a no-load product. I want to make sure to make that clear.
Yep, no-load product.
Okay. And one of the things that's interesting about liquidity, a lot of people don't realize this, is that when there's too much liquidity, the manager, be it a mutual fund or whatever, it kind of hampers where they can invest because they always have to keep funds on hand. Otherwise, they're forced to liquidate when people want to liquidate. Go ahead.
Yeah, liquidity is an interesting concept when it comes to your investments, because I've had people call asking for more information about our mortgage-backed investment opportunities, and very often it's, what about liquidity? Well, if you're investing in an individual note, that in the term of that note is 12 months, and you need to cash out of that note, well, you can sell it to a third party, and there are actually some very successful companies, actually several of them based in, one in particular based in California, where you can sell a deed of trust that you've invested in, because otherwise they're not generally liquid, but they are in demand, and you can generally sell them at par, meaning you don't have to take a discount to sell a 8 or 9 or 10% note on the common market. Now, if it's a mortgage pool fund, most mortgage pool funds have a minimum investment requirement, and there's a penalty for early redemption. At Pacific Private Money's fund, we have a 24-month minimum investment period. So
okay, that's not much, because I have heard of other ones that have 5
year, 7 year, yeah. So 24 months. What we found, we chose 24 because my experience with over 500 privately funded notes that we've originated since 2008 is that there seems to be a sweet spot among my lenders as to the term that they want. So for some, 12 is too short, and then 36 is too long. So 24 seems to be just right. And then getting back to the no load feature of it. So let's say you're interested in funding either an individual note or putting your money in a mortgage pool fund. These are no-load investments, meaning if you invest $100,000, your entire investment goes to work. It's not reduced by any commissions. You're getting the, if it's an individual note, you're getting the promised yield On that entire 100,000, if it's going into the mortgage pool fund, you're going to get what that mortgage pool fund rate pays, which is usually a combination of a preferred return plus a split of the profits. So, but all of that money is going to work for you, the whole 100,000. And then when you get paid off in an individual note, or in the case of a fund, if you request a redemption, you get the entire $100,000 back, all of it. And in fact, in our office, we oftentimes are wire monies back and forth. We'll cut you a check for the wire fee that the bank charges you for that. So it's really almost in the purest sense, in the truest sense, a no-load investment. And I know people really, really appreciate that because nothing worse in investing than getting nickel and dimed in fees.
Well, especially you invest 100,000 and let's say 3% comes right off the top. Only 97,000 is working for you.
Well, look at the insurance annuity products. I mean, most of those are based on
like 10-year ones, and some of them have 10 to 15%
right, so
withdrawal
talk
penalty.
about lack of liquidity, early withdrawal penalty, and how much of that money is actually going to work for you. And in a pinch, if you had to cash out, what's left?
And I have my insurance license, and I can sell annuities, but you know what? I generally don't sell them for that reason. I don't think they're a great deal for the client.
So let's talk a little bit about risk. Don't high returns mean the investment is risky?
Well, usually
in a level playing field, that statement is generally true. If over here I can get, I have, AAA rated bonds, which are generally considered pretty darn safe, but they're only paying 3 or 4%, or I've got my, in a money market account, but I'm getting 0.25%. Put it in stocks, and I have no idea what I'm going to get back. It's kind of a hope and a prayer, but when it comes to alternative investments like mortgage secured lending, high returns do not necessarily mean high risk. In fact, in my opinion, and in the opinion of a lot of my clients who are thrilled to have discovered this investment opportunity, they think that it's far less risky than the stock market, and in fact, less risky than some, muni bonds and other bonds out there that, that some people
the principal can change quite a bit on muni bonds, especially when the interest rates go up. And then also you get some of these bonds where the market tanks because they went bankrupt.
Right, and so mortgage investing is not prone to the wild, stomach-churning fluctuations that often, terrify the average investor in the stock market.
And just to remind people, you're listening to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money. For more information on investing in mortgages, getting a return of 8% or more, 415-883-2150. And Mark, I know the audience is listening to this going, okay, well, it sounds a little risky because it's 8%. You're telling them it's not very risky. Give an example, and one of my favorite ones, the one that you just recently shared with me about the one in just north of Sacramento, about the gentleman who wanted to buy his house and the bank with the credit.
Right. Well, there was I'll do that one really quickly. That was a short-term bridge loan for a family that fell out of bank qualification and was ready to purchase their home. And actually, it's funny, we're getting more and more loan requests of that nature, where something happens during the time they're in contract to buy a home. In this particular case, they were having a home built for them. And during the 6-month period, they fell out of qualification because an unexpected and erroneous tax lien showed up on their credit. And the bank said, well, we can't, you have to clean this up and then come back. And
you mean the IRS sometimes makes mistakes?
Yeah, right. So we were able to help a family with a short-term loan for 11 months, an 11-month bridge loan, to buy their dream home in Danville.
Well, why didn't the seller just extend the term?
The seller was a builder, and the builder's in a business of building homes, completing them, and selling them, and putting that money back into the coffers. Yeah, that they were going to sell it to the next party. That family was going to lose a $50,000 hard deposit on that property if we didn't come in there and make that loan.
And if I remember correctly from the story, they were in contract for $750,000, and the backup offer to the developer was about 900,000.
Yeah, it was.
So the developer was actually hoping that this family was not going to buy the house so that they could sell it to the next highest person.
So that's not the typical loan we make. The typical loan we make is to someone, as we talked about earlier, who's in the business of investing in real estate, and we generally make purchase money loans to experienced real estate investors who are buying, fixing, and then reselling Bay Area real estate. So we're a Bay Area company. We focus on Bay Area and Sacramento Valley lending opportunities. Most of our clients, our lender clients, live in the Bay Area.
So you're not doing Cleveland and Detroit
No,
like some other lenders.
No,
out
we're
there.
very
Okay.
focused. This is I've personally been in real estate my entire career, over 30 years. I was raised in a family of builders. Real estate's in my blood, and I've only lived in the Bay Area. I know the Bay Area very well. Very well. I'm very comfortable lending and evaluating real estate in the Bay Area. But we know the neighborhoods, right? So
Yep.
I don't know the neighborhoods in Austin, Texas. I don't know the neighborhoods in Phoenix, Arizona. I don't know the neighborhoods in Athens, Georgia. And these are all, we get phone calls weekly from outside. You know how the internet is. People see our website, they don't read carefully California only, and they call me, can you make me a loan in Detroit, Michigan? Thank you, but no, I don't know that area. So we only lend in Northern California, and most of our loans are to real estate investors. Now, talk about like the loan of the week. I'm working on a loan application right now on a small Berkeley office building, about a 10,000 square foot office building. It's got mostly professionals in there. It's got a bunch of doctors and stuff. It's very near the Cal campus, and I know because of my experience as an investor in commercial real estate, I don't need an appraiser to tell me that this property is worth approximately $3 million. Well,
and you said it's how many square feet?
About 10,000 square feet,
Okay,
and based on the rents, there's a calculation that you do in commercial real estate. You take the rents, you deduct a vacancy factor and the operating expenses to get a net operating income figure, and from that figure you can calculate a value estimate based on a capitalization rate. Not to get all into
but also
stuff here.
$300 a square foot for Berkeley. They're near the campus is not an unreasonable value.
It's not. So, but the key to the loan application is that it's free and clear, and the property owner only needs about $600,000. So, even if it's arguably, so forget about $3 million. What if it's worth half that, $1.5 million?
Yeah.
$600,000 loan request, that's below 50% loan to value for a cash out request on a free and clear income property that has great debt service coverage, as we call it in the industry, meaning that the rents of this building are far higher than the monthly loan payment they're going to make me on that loan. So I just love a deal like that. That's a great loan.
Okay, so again, I'm the audience listening here, and I'm saying, if a guy's got a building that's worth $3 million free and clear, and he only needs $600,000, which is 20% loan to value, why is he coming to you and borrowing at 8, 9, 10% interest, whatever it is, compared to the bank, which would probably lend him at about probably 5 or 6%?
And this is a classic story. He needs the money quickly because he found an opportunity to buy another real estate investment, and he can't wait for the 45 days minimum that it's going to take to get a loan on his commercial property. That's number one. And number two, banks don't typically like small commercial loans. They like large commercial loans. Now, if the guy wanted $5 million on a $10 million building, he could find banks would line up for days to service that.
Here's another problem that he might have is that a lot of banks really do not like what they call cash out loans.
No.
If you're just refinancing one loan with another, that's one thing. But if you're just taking money out of the building, they get a little nervous about that. I think it's because you've been living with the building with no debt, and so your income is X, and suddenly now it's going to be X less the mortgage payment, and they have no idea what you're really doing with the money.
So the point is that the private lending industry today, and specifically our company, Pacific Private Money, we've been marketing ourselves for years. We're on Facebook, LinkedIn, multiple websites. I speak in front of real estate groups. We've got a huge email database of real estate professionals who are seeing loan applications from all over the Bay Area. And so we've achieved in our particular business a critical mass where our phone rings consistently and daily with loan inquiries. most of those are not in our wheelhouse, quite frankly. So we say no sorry to an awful lot of loan scenarios that come in either directly from a potential borrower or maybe from a real estate mortgage broker who's got a deal that his bank doesn't like.
Okay, this is just off the fly. Roughly, what's the ratio? How many calls do you get, and how many yeses do you give?
We probably like 1 out of 5, 1 out of 4, 1 out of 5 inquiries.
Well, that's not bad.
It's right. We get. I mean, they're not junk inquiries generally, but it's someone will call and he'll need super high percentage financing. He'll want a rehab loan where he's buying a place for $200,000 and he's going to put $50,000 into it. He wants to borrow most of that $250,000, and we say, "Well, sorry, we only lend based on the purchase price. Whatever you're going to improve, you got to have that capital from."
Yes, you're not looking at the after repair
right.
value.
So you either have to have your own capital to put in, or you have to have your own equity partner for that. So again, we focus on the more conservative lending requests here in the Bay Area that the banks turn down.
Okay, and again, you're listening, audience,
Yes.
to
Well, we're listening too.
We're listening to each other. Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hanf, who is president of Pacific Private Money, one of the fastest growing private mortgage firms in Northern California. Pacific Private Money can be reached at 415-883-2150. You got to call them to find out how you can also earn 8% on your money, just like we've been talking about here on the radio. We're going to cut to our second commercial break. Here's the trivia question. Again, the theme is movie quotes. In what movie does announcer Bob Uecker say, "just a bit outside"? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. In what movie does announcer Bob Uecker say, "just a bit outside"? Again, that's 888-529-1134. Make sure to include your name, your email address, speak slowly, spell out your email 1 letter at a time. Don't touch that dial, because Mortgage Investing 101 will be right back with Mark Hanf and Edward Brown.
So, what we haven't done is talk about, the complication or how complicated the investment is. It sounds like it must be pretty
good.
So maybe your question to me should be, so Mark,
complicated?
this sounds like a pretty complicated investment.
Okay.
How complicated is it?
Who's the guy who's doing the mortgage website? What your intern?
Oh, Marcus.
Marcus. That's his name.
Yeah, I know. He comes in late, and so like today, I'm getting ready to leave, and he's coming in, and I, on my list it's like, Marcus, have you gotten to me the stuff so we can get it to James and he can upload it to the site? So I need to get him.
Does James have to upload it, or can you?
Well, actually, I don't know. I'm not really sure how to do that yet.
If he set it up the same way as I did, I can show you.
Okay.
And
If
I can do it, you could for sure.
Right. Someone has to show me once. I haven't used this particular platform that often.
In fact, I had a guy come to my house who wasn't familiar with it, but helped me, and then he helped me take some notes. So what I'll do is I will scan and email those notes to you, because that will really help.
That would be good. But still, I don't mind paying James. Just here I've uploaded the videos to YouTube, and here's the other stuff.
But this will help in case
we need to get
he's not there someday.
Yeah, that's true.
42. Yeah. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. Again, Pacific Private Money is a place where you can earn over 8%, usually over 8%, on your savings and IRAs. And you can reach Mark at 415-883-2150 for more information. When we cut to the second commercial break, we asked this trivia question. Again, the theme is movie quotes. In what movie does announcer Bob Uecker say, "Just a bit outside"?
Is that Major League?
Major League, that is correct. Okay. Now,
is that Wild Thing that made
that's that's exactly it, Charlie Sheen. Okay.
Back when he was easier to watch, not as scary looking as he is.
Yeah, that is true. Okay, now on back to the serious stuff here. We're talking about mortgage investing. Now, Mark, we've talked about investing in mortgages and Pacific Private Money. I'm a little concerned, though. It sounds kind of complicated. How complicated is it investing in the mortgages?
Well, and that's a great question, because I think that is what concerns some of the newer clients that call. It's like, well, it seems like it must be fairly complicated and hard to understand. And of course, for me, I do this in my sleep. So and I've done so many loans over the years that literally, when I get a call from someone who's applying for a loan, I can usually within 3 or 4 minutes determine whether or not I want to go any further with that application. Sure. Green light it and start collecting the information. But that's because I've developed kind of a sixth sense for these types of loans. These basically real estate investor type loans that we talked about in the last segment that are kind of our bread and butter wheelhouse type loans. But really, it's not that complicated. So when you invest in a mortgage secured product, whether it's a individual loan, also known as trustee investing, or a mortgage pool fund,
which is similar to a mutual fund of a bunch of mortgages.
Lots of loans, right? Exactly.
Okay.
So when you invest in either of these mortgage secured products, you're essentially participating in what we call private lending, and it's really no different than bank lending. So you are the bank. You're providing your capital for this fund. So when you go to a bank, when you go to Wells Fargo or Chase or Citi or whomever, B of A, and apply for a mortgage, they approve that loan, and then they go and they get the money from either their deposits, or they go to the overnight window and borrow it from the Fed, and they fund that loan. When we get a loan request, we underwrite the loan, determine that it has the safety and security features that we solve for on behalf of both the borrower and the collateral, and then we introduce this loan to our investors if it's an individual loan, or if our mortgage pool fund has capital, we'll just fund the loan straight out of our mortgage pool fund. So in both cases, your funds are basically the same as if this loan were funded from a bank. There's really no difference. We have the same types of loan documents. We have the same disclosures. We have the same type of promissory note and deed of trust. In fact, if anything, I think our notes are actually better written, more tightly written, and stronger contracts than the consumer home loan product. Because again, we're making loans to real estate investors. These are business purpose loans. These are not generally consumer loans, and therefore we can be more stringent and have stronger, I was going to say harsher, but stronger terms, so that it's really, so in other words, our loan documents are very lender friendly, not borrower friendly. So, we charge a late fee after 10 days, not 15. Our late charge is 10%, not 6%. If you go into default, meaning you miss a series of payments, we jack your rate up 4 percentage points. There's a default rate, and again, this is a business, guys. So if you're in the business of real estate, of making a profit in real estate, we're in the business of providing you that capital, but we're not going to mess around.
Do you also have Guido with the baseball bat following the borrowers?
No. We're really nice to work with. In fact, Debbie in our loan servicing department is a doll, and she's very good at being even keeled with both borrowers and our lenders, who sometimes wonder, maybe there's a late payment. The lender will call and goes, "What's with that guy? How come he's always late?" But again, late is not necessarily a bad thing because we collect late fees,
There you
and
go.
half of those late fees go to the lender. So anyway, to get back to the complexity of it, it's really not all that complex. The borrower calls us up, sends us an application. We use the Uniform Residential Loan Application, just like the banks do. We collect a credit report. We do a background check. We ask for bank statements and proof of funds. Sometimes we get their tax returns. I mean, we
Oh,
do.
you're doing your due diligence.
We do our due diligence on the borrower side. Now, on the collateral
side,
side, the house, the property, we're getting an appraisal more often than not. Sometimes we can waive that if we know the area really well, and it's a purchase loan that's been listed on the MLS, and we know that the price of $200,000 is spot on. There really isn't. An appraiser's not going to tell us anything more, but more often than not, we're getting third-party valuation. We're getting a preliminary title report. We're getting a title insurance from the escrow company for that loan we're going to provide. It's going to be recorded through the title company. Again, we use, everything's done third-party professional title companies. We get an insurance policy that names the lender or names whether it's an individual lender or the fund. So it's really
okay. So they're well protected.
Well protected.
I want to say one thing about the getting an appraisal. Because years ago we made a loan to somebody, and this was on Lombard Street. Yeah, so it was prime San Francisco property, and he only needed $200,000, and we knew the property, as they say, fire sale, $1 million. Like literally in 10 minutes, if we had to sell it, we could sell it for $1 million.
Yeah.
So in a case like that, the guy needed the money quickly. That's a 20% loan to value. We went to bed at night hoping he would not pay us so that we could foreclose and get all that equity.
No, that's absolutely right. And just like the example I was telling you in the last segment, I was describing to you this 10,000 square foot Berkeley office building. I can take a look at the leases, I can tour the property and walk through it, and I know all day long in my head that this property is $2.5 to $3 million.
Yeah, it's not like it's falling down.
Right, and so for a $600,000 loan request, it's 25% loan to value all day long.
Yeah.
I don't need to go out and make the borrower spend $3,500 on a commercial appraisal, which will take 3 weeks. It'll be 150 pages long, and all it's going to be is a bunch of worthless demographic information that nobody cares about. Because really, at the end of the day, we just want to know, how did you calculate the value? What's the math?
And here's the interesting thing is that, when people think about, oh, your interest rates are so high compared to the bank. Well, if he didn't have to spend $3,500, that is a little over a point. If he doesn't have to pay.
And if he can get his money in 2 weeks instead of 6 or 8 or 9 weeks, and be able to execute an opportunity that he would lose otherwise, there's value in that. So again, the price of the money, people get all caught up in, gosh, if the borrower's paying 10%, he must have really lousy credit, or it must be really risky.
Yeah.
No and no.
Yeah.
I do have some borrowers with credit that's been damaged by foreclosures because maybe they're real estate investors. They may have bought a bunch of properties in 2005
and again, you will
lost them.
and you will get requests from people who want to buy a $200,000 property and they want to borrow $199,000 and their credit is lousy.
Right.
But in that case, you say no.
Right. We don't make those kind of loans. In fact, a lot of our borrowers have stellar credit, and they're making really good money in this current real estate market we're in, which is generally stabilized. It's rising. We're experiencing appreciation in most markets.
And in fact, here's another reason that people come to you rather than a bank. You're so much easier to deal with. There are reams of paper that some people just are not. They put a price on their time.
You don't even know how much easier
we
are than a bank. There actually is. And I was going to use this example earlier, and I didn't because it's the exception, not the rule. But I actually have a couple of clients that are 100% bank financeable, but they're so aggravated at the banks, and they're so sick and tired of dealing with some young know-nothing banker that is asking them the stupidest questions and making them come up with reams and reams of proof.
For that $300 deposit, where did that come from?
Whereas we don't, we can do a much more effective and efficient common sense appraisal of the borrower and the collateral without having to paper the heck out of the deal. See, the banks are trying to, in my opinion, they're looking for a reason to say no.
Yeah.
It's really a CYA, cover your you know what,
Yeah.
for them, because that file is subject to audit. I mean, our files are subject to audit too, but we're looking for a reason to say yes.
Sure.
But
Well, in this case, like the one with the Berkeley, and again, property 10,000 square feet,
Mhm.
worth $3 million, free and clear. Gentleman wants to borrow just 600,000.
Right.
A loan like that, I know you're not the type of guy to, twirl the mustache and throw people under the railroad tracks, but in one sense, aren't you kind of hoping he gets the money from you and doesn't pay you?
Well, depending on how we fund it, if we have a private individual lender on this one, which I think we probably will, you're absolutely right. That lender is going to hope and pray. And in fact, I do have some clients that their entire real estate portfolio they got from foreclosing on properties they loaned on, but they're thrilled because they ended up getting back properties that were worth more than their loan. Now that's very rare. I'm going to tell you that right now. We have out of 550 loans we've originated since 2008, we have foreclosed on less than 10, and none of them were resulted in the loss to principal.
Okay, so
to the lender.
in the years that you've been doing this, the 500 loans, nobody has ever lost. No, none of your clients have ever lost money.
That's correct.
That's a major coup for being a conservative little old lady investment.
Right. So,
and again, you're listening to Mortgage Investing 101 with Edward Brown and Mark Hahn, and Pacific Private Money can be reached at 415-883-2150.
but I was just going to add, just to be the devil's advocate, so no one's lost money since 2008. Yeah, but what about the people who all lost money on loans that they funded when the market turned? Maybe they made the loan in 2006, and in 2007 and 8 we know what happened. Well, let's talk about that a little bit. If we're only making loans no higher than 70% of today's value, whether it's the purchase price or whether it's valued by appraisal, how much would that property have to go down in value in the next couple of years? Again, we're talking about short-term loan, right? We're making a 12 to 24-month loan. That property would have to, the market would have to go down 30% for you to be at risk of losing principal, right?
Yep.
Now, if you believe that that's going to happen again, well, then maybe you should just keep your money in CDs and bonds, because quite frankly.
But we're not getting enough interest, Mark.
Because I've seen. I was a teenager in the first cycle in the early '70s of real estate, but I've been through a number of cycles in the real estate, and yes, real estate will go down again in value. There'll be another cycle, and there'll be price depreciation.
But because you're not lending at 100 cents
we're
on
not
the dollar,
lending. We're not doing 80%. We're not doing 100%. We're not doing.
You can have corrections and still be okay.
Right, you can have corrections.
Here's the funny thing is that even if it corrects, even let's say you did a 70% loan to value and property values drop 30%, that doesn't mean the borrower is automatically going to stop paying. Sometimes these people, they had invested $100,000, $200,000 in the property, they want to keep it, they think if the market's going to turn, they don't want to get foreclosed out.
Right. So we anticipate some kind of correction in the market going forward. I don't know that it's going to happen, but we're anticipating it by not lending at more than 70%. So in the event that we do have a 10% correction, because let's say mortgage rates for some reason go up higher than anticipated. In fact, there's an article I read this week about basically they did a poll of financial experts, and the question was, at what rate would mortgage rates need to rise to in order that would impact the market negatively? That would be a strong negative force on the real estate market, and that number seemed to come around 6. People were thinking, well, when we hit 6%, then that's going to start to really impact. But what if it goes to 8? Okay, well, how is that going to impact? Maybe we see a 5 or 10% correction.
Yeah, but on those fix and flip people, though, remember they're putting money into the property and improving it.
Right.
So you're going to be less.
That's exactly right, and they're selling it pretty quickly. So again, on most of our loans are paid off within 6 months. The vast majority. We're not getting into 5-year loans.
So Mark, again, how do people get a hold of you? Because these investments sound pretty darn good, pretty conservative, and yet they're paying a great rate of return.
Right. So for more information, when I say more information, I mean we have information we can send to you that you can read and study. We are not out to sell you anything and convince you that this is where you should invest your money. We want to educate you as to why you should strongly consider diversifying your portfolio with mortgage investments. Call us at 415-883-2150 or go to pacificprivatemoney.com.
All right, next week we're going to have Michael McNair from IRA Services Trust Company, who's going to explain how you can invest your IRA in these deeds of trust and other investments. They're an excellent company. Mark and I both use them. Very reasonably priced. Check them out at iraservices.com. Tune in next week to Mortgage Investing 101. We're going to be giving away more free vacations for answering trivia questions and giving more valuable information about mortgage investing and also talking about Deal of the Week. You always want to hear what the Deal of the Week is. Thanks for listening. I'm your host, Edward Brown, and on behalf of Mortgage Investing 101, so long. We'll catch you next week. That deal, what's the interest rate that you're charging